Hello and welcome to our latest episode of the Wealth Amplifier podcast here at Amplius Wealth Advisors. As a reminder, the goal of our podcast is to amplify a person, topic, or idea in a brief 15 to 30 minute conversation. Today, we are really lucky and privileged to have Jason Granet, the Chief Investment Officer of Bank of New York Mellon, as our guest. And before I introduce Jason, just as a reminder, always on these podcasts, nothing that we discuss today should be construed as investment, legal, or tax advice. You should seek the counsel of your personal investment, legal, and tax advisor before making any decisions. With that, Jason Granet, welcome to the Wealth Amplifier podcast.
It's wonderful to be here. Thanks, Matt.
So before we dive into some of the topics we wanted to talk about today, let me just see if I do a decent job giving everybody your bio here, given that we go back a long way.
I'm a little nervous how this is going to go.
Yes, so first things first, as you see behind Jason, a graduate of the University of Michigan, undergrad, where he attended with my wife. That is the original connection, which we'll get to in a moment. And then from there, if I'm not mistaken, you went directly to Goldman Sachs. Is that correct?
That is correct.
And you were there for the better part of 20 years.
21. I hit blackjack there.
You hit blackjack at Goldman Sachs, finishing in your last role at Goldman Sachs. I know you were a managing director, but what area were you involved in at that time?
So the last role I had there, I spent the bulk of my career in asset management, managing fixed income portfolios. And I don't know if you want to get to this, but 7 of those years overseas in London. But my last role, I was working directly for the treasurer of the firm and helping the firm and its clients navigate through the transition of LIBOR, which as we speak here in February of 2023, we're down to the last 3-4 months of that. So, that's in the final stretches, but that was my last role there.
That was your last role. And then, so when did you start at Bank of New York? How long ago was that now?
So I joined here just after July 4th of 2021. So I'm somewhere in the 18-19 month into my role zip code. And as I'm sure when we get into talking about markets, it's quite the wild ride over the last 18-19 months for sure.
Right. Something happened in interest rates over the last 18 months?
Yeah, 400 things happened.
So why don't we start there? Tell us a little bit about your day-to-day, what your role is at Bank of New York, and then we'll start talking about interest rates and the markets in general.
Sure. So here at BNY Mellon, the bank is a very much a classic organization. We touch 20% of the world's investable assets. We have well north of 40 trillion securities under custody, and we are just heavily involved in capital markets from A to Z, as they would say in the UK. My role is on the asset side of the balance sheet. I have 2 roles. One is my day job is I look after the liquidity portfolio, the securities investment portfolio of the bank. That's somewhere in the neighborhood of 140, 150 billion dollars worth. And then I work very closely with my partner, the chief lending officer, and he and I together think about the strategy for the entire asset side of BNY Mellon. And so I have this day job of navigating the investment portfolio, which is largely an interest rate risk portfolio, and I'm sure you and I will get into that. And then this more strategic role where I think about the direction of the assets for the balance sheet in aggregate.
Got it. And so why don't we start there? As you alluded to a couple minutes ago, it's your time at Bank of New York Mellon has been probably a bit, you might have a different example, but probably the most interesting time in the markets and in particular the interest rate world, I would think, since the global financial crisis over the last 2 years. Maybe you have a counter example, but either way, it's been pretty interesting. Tell us a little bit about that in the sense of what you expected when you arrived in your new role, and how those plans may have changed a little bit given the macro backdrop and everything going on right now.
Sure. Look, interesting markets come in different flavors. I don't try to think about it. This one might be pistachio or mint chip, and then other ones that have had other things happen in them, or could be other flavors. But look, I was a person who joined the firm in the middle of COVID. We can discuss if and when and where COVID is going, but in the summer of 21, COVID was very present. Um, we were about a year and a bit after COVID broke, meaningful stimulus coming from the government in all different forms through COVID response that had yielded the fact that the Fed took interest rates all the way back to zero, very similar to what they did during the financial crisis after during the events of fall of 2008. They relaunched a lot of the programs that they relaunched in the fall of 2008. They did a lot of things to inject liquidity and support into financial markets, given what was happening in the macro backdrop. So for all of 2021, rates were at zero. The Fed's target range was 0 to 25. They were buying bonds. This was a time that was characterized with meaningful stimulus. So I joined right in the middle of that, and interestingly, I joined directionally as a more remote employee, even though I was coming to the office. And you see me here in my office today, and we're back in the office. But I was coming to the office, I would describe as sporadically. And it took me a while to even meet many people on my team, and a lot of the colleagues that I work with. That took as long as anything else. And so there was this, if we take ourselves back to that world, it was a very different environment, both that we were physically living and from a market backdrop. And then as I kind of joked a minute ago about the 400 things different happen over the course of 2022. The Fed hiked interest rates somewhere in the neighborhood of 425 basis points. The target range went from 0 to 25 to 4.25 to 450 over the course of last year, and we went completely away from zero all the way up to rates that hadn't been seen in a very long time, since the early aughts, right? Like
Yep.
right after the dot-com, before Lehman, Bear, and all of those things that happened. And so, I have this view that a generation on Wall Street is something like 10 to 15 years, just because of the nature of job turnover and people managing risks and doing different things. So it's been a Wall Street generation since we've had any interest rates like this. And we also got rate hikes in 75 basis point clips, which wasn't really a thing since Volcker in the late 70s, early 80s times. And so we're really talking about multiple Wall Street generations and real life generations when we had movements in interest rates of that magnitude. And obviously that was accompanied by significant inflation, and we can talk a little bit about, but there was this reaction function to a lot of the stimulus and a lot of the activity over the COVID period that kind of it was, the way I think about it was like a tightly wound coil, and then it kind of sprung in 2022. And then here, as we talk in the first quarter of 23, the Fed is trying to get its footing, even though we're seeing some inflation come down, some of these things come off. They're trying to find their footing on what the next phase of this looks like, and the weeks that we're talking, we've seen very big repricing, and even as locally as today, ironically, as we talk here on the 21st.
Yeah, and I think from your perspective, from an economic point of view, what lever do you think the Fed is trying to pull right now? And from the perspective of, a lot of people listening to this podcast, interest rates affect their life in any number of ways, whether it's floating rate debt in the form of mortgage, student loans, so on, how interest rates impact the capital markets with stocks, bonds, et cetera, the housing market, certainly. But with the Fed raising rates, presumably to try and get inflation under control, what part of the economy do you think they're trying to have the most impact on? And do you think, best you can tell, that is working from some of the data you look at?
Yeah, so two things. One is the Fed has a dual mandate: full employment and inflation. So let's look at both of those things. If we look at full employment, employment and the labor market is very strong right now. There's all the data is showing that the labor market is very strong, very resilient. The most recent report that was released was shockingly strong. I think
Yeah.
if you strip away any seasonal adjustments or any of these types of things, I think it was the strongest January employment report in 15, 20 years, maybe longer, but I know in a very long time. And so we're talking about a very, very healthy labor market. That's something the Fed is very focused on, given it's one of the pillars of their mandate. And actually, I would argue that there's some room there. Chair Powell and other Fed speakers have talked about this idea of loosening the labor market, having it be a little bit weaker is one of the things that they might need to generate a little bit more slack in the economy so that other aspects can normalize. So that's one pillar, and that's very strong. And they're, even though they've moved interest rates in this historical clip, as we were talking about a minute ago, we're not really getting movement over there. The other side is inflation. We're seeing inflation again in multi-generation highs, going back to the late 70s, early 80s, with these types of numbers. It's not necessarily a phenomenon unique to the United States. We're also seeing this in other parts of the world and developed economies. Bank of England is dealing with something similar. ECB is dealing with somewhere similar, and shockingly, even in Japan, where they've been without inflation for forever and ever and ever, there's definitely signs that they're wrestling with some there as well. And so the Fed is hiking rates because this classic paradigm of inflation minus interest rates equals the real rates. They have inflation
Yeah.
really high, and they're trying to get that under control. And so you're seeing inflation back somewhere north of 6 in the most recent reading. It was north of 9 not that long ago. And so they're definitely doing things to get have disinflation, but they have a 2% inflation goal. And they are far away from 2%. And so there's clearly some work that needs to be done. So if you look at the two things that they kind of on their chalkboard to attack, the labor market and inflation, there's work to do on both, which is why the market is telling them you're going to have to continue to hike interest rates, and that's why we're seeing that in the market. Now you're right. You mentioned that this idea that the people that you deal with, the way that interest rates feed through their life relative to the broader economy. One of the really interesting things that has happened since the financial crisis is the Fed has rolled out all different tools and all different things. And so interest rates really aren't the only thing that the Fed plays around with. They have the size of their balance sheet. They have what they call the reverse repo facility, how money market funds can leave money at the Fed, how much they pay for banks to leave their money, or what they call interest on reserve balances. And so there's all these different matrices of things on the dashboard that the Fed is tinkering with or talking about tinkering with to try to attack those things that we discussed. But if we went back to that Volcker era, they really only had interest rates. That was the only vector they were playing with, and now they're playing with all these multi variables and vectors. And the reality is this is the first time that the Fed is dealing with inflation at this level, where they have all these different dials on the board to kind of maneuver, as opposed to just the interest rate vector. And so I think that as they go through this, there's definitely some learning being done on their part, because a lot of these are a little bit of the first time or the first cycle or the first go that they're doing certain things.
And in your, I guess, bringing that back to your day to day, how how important is it for you to have an overall, let's say, macro outlook, for a lack of another term? And to the extent that you have one, how far out are you usually looking there? Like what time horizon makes sense for Jason when you're evaluating the broader capital markets on a day to day basis?
So here I kind of think in three stages. We have the very near term. What is the Fed, or what's going to have interest rates this week, this month? We have to real time affect that. I work very closely with our treasurer and our businesses. We have a very significant amount of depositors. That's a big part of our business here. And so real time interest rates matter for real-time deposit rates and real-time business decisions. I said I work very closely with our chief lending officer on real-time lending decisions. That being said, I tend to think in something like 2 or 3 year increments. I find anything longer than that kind of pretty hard and tricky. What's the cycle? What is it going to look like? The Fed, if we think about the 2 or 3 year increments here, the beginning of last year, the Fed started a cycle where they were shrinking the size of their balance sheet, starting to raise interest rates. If that plays out, as the market is saying, through the end of this year before they stop hiking rates, that's kind of a 2 year time frame. If you look at other cycles, you get things in like the 2 year time frame and where central banks tend to move and react. And so that's how I tend to think about risk profiling. And then obviously we have the longer term. We're thinking about the direction of the balance sheet. We're thinking about the longer term interest rate models that we run, the longer term things, because quite frankly, a lot of other risk markets and a lot of other market participants think about the longer term interest rates. You'll hear the most quoted thing being the 10-year note. Even though the
Familiar with that
reality,
one.
yeah, even though the reality is for us, we're operating somewhere in the 2-3 year zone for the bulk of our risk management and risk profiling. Obviously, you have to be mindful of where tens are as a bellwether for everything else, and later. And so that tends to be how I bucket things and
Yep.
react to things. But you know, there's a emotional overlay to a lot of this, and one thing that's kind of played through markets, definitely through COVID and definitely through this inflation period and the Fed fighting that's come after, is kind of what is the reaction function? How do people think? How does it get talked about? What's the PR of the market? And sometimes you get the longer end of the curve captures the imagination of the PR of the market, and so that's also a reason why it's important from sentiment and otherwise to be mindful of it.
And we, when we launched this episode of the podcast, we did mention, as we always do, that we're not giving specific investment advice on the podcast. And that still remains the case. That said, I'd just be curious, with your 2 to 3 year outlook, even if it's qualitatively, quantitatively, what are you looking for over the next 2 to 3 years? Are we entering good times, bad times, mediocre times? And maybe what's a surprise or two you think that maybe the markets are not factoring in that could rear its head over the next year, 2 to 3 year window that you were mentioning?
So again, while not giving advice, I can give you some broad strokes about how I'm thinking about things.
Sure, please.
I definitely, as the markets were starting to price a very quick reversal from the Fed here later this year and into next year, and one of the themes that I had been playing and thinking about is that that's unlikely the Fed is going to very quickly turn back around. I think that there's a good amount of work to do, as I indicated, where inflation and labor were, and so I thought the market was a little excited about the ability to get that under control, and my belief that kind of as a result, rates would probably linger out longer, and the Fed wouldn't turn as quickly. And so there's different ways in which different investor types or others can think about that. The other thing that I've been thinking about generally is that, last week I was reading the CBO's release about kind of the budget for the government. And while there's a lot of focus on this year for the government, we're sitting at somewhere in around $31 trillion of government, of U.S. Treasury outstanding. And the CBO is calling for something like 46 trillion in 10 years. And so one of the longer term things I've been thinking about is, that's a lot of supply. Where's the demand and where's the intersection point of supply and demand? And I think over the last 10 or 15 years, the world has gotten very used to the supply and demand of the bond market intersecting closer to zero than not, whether it
Yep.
be from the financial crisis through COVID, et cetera. And I think there's a good amount of people that are anchored that we're going to return there. Whereas kind of my bigger theme is that we're probably going to have an intersection of supply and demand somewhere a lot further away than that. And I think that the market kind of there's a segment of the market or a cohort that got used to this kind of near zero for quote generation as I defined it, a Wall Street generation of 10 to 15 years. And so the bigger theme that I'm kind of been thinking about is this idea that like the intersection of supply and demand of risk-free rates and government bonds is probably at lower prices or higher yields, depending on how you think about um, quoting it, but definitely in a different place than where it's been. And so that's kind of like a bigger, broader theme that I just generally think about is what does the trajectory look like? Because if you look at bond markets since the 70s and that Volcker time that I look at, we always made kind of the highs and yields in each cycle were always lower. And we've kind of broke that pattern here in this most recent round. So we now have the first time we have a high in yield that's actually higher than the last high in yield in different cycles.
Exactly.
And so the question is, are we now trending in that? And when you triangulate that with the data that the government publishes on the size of the markets, you look at what the size of the UK gilt markets, the size of the JGB markets, the size of the high quality government bond markets in Europe, et cetera, and you have this crazy supply story and demand, like what does the intersection look like? And to me, I think that that's a really big theme that all types of investors, all types of people following markets should be mindful of over the next 5, 10, whatever it is, horizon. And so, very locally, I answer the question. I think that, it's unlikely the Fed's going to turn back really quickly, but then more kind of taking a step back, I kind of see this broader theme that I think is really important. And quite frankly, that's how I approach it. We're here at America's oldest bank, 238 years. We had the Hamilton family as some of our first investors, for those fans of Broadway. And we, so if you think over long term, we've seen all types of stuff, but we're likely to see a different tone in markets going forward. Broadly speaking, in decade terms, not in day and week terms.
Agreed, understood, and I think bringing it even to the shorter term. One more question I had on rates, then I had a couple other things to for you there. But one thing we're hearing a lot about this year is the debt ceiling that's been out there. How much is that factoring into your thinking these days? And what are you even doing to prepare for such a sort of I don't know, self-inflicted bizarre risk? But what are your general thoughts on it?
Yeah, so look, this is something that has happened repeatedly over many times. They seem to conclude with Congress coming to uh, an appropriate solution when the chips are properly on the table. We believe that that is likely to play out over the course of this year, not without a few bouts of volatility. Instead of thinking about it kind of locally, I would say that the debt ceiling is it would be something very micro. Someone who's invested in very short-term bonds is likely to be volatility as we get through the summer. Again, referencing that same CBO report, I think they said something like July to September is kind of the window when the government's going to have to reconcile the facts and figures. But like again, taking a step back, I think the bigger picture is that idea that we're going to get to 46 trillion and we're at 31 trillion, and kind of what does this mean as a broader dynamic for markets? And again, to me, that just means the supply and demand has to intersect at a different price over the horizon. And so while that's less, while I think that every time, whether it be this or some other time that we get into some debt ceiling negotiations with Congress, there's likely to be very local disturbances in the market or bouts of volatility or things like when you zoom out, those things will look like little potholes in the highway, but the bigger highway is just pointed in a very different direction. To me, I think that's the bigger story here. And then the question is there something that that Congress or the government does to bend the broader expense curve of the United States of that trajectory to 46 to bring that number down or do something different? Does one of these debt ceiling negotiations actually change the trajectory of that? To me, that's almost a bigger, more important thing to watch than local volatility, which you can get because of lots of different reasons, and that will be this summer's reason.
Well, call me a skeptic, but I'll believe that when I see it. If that curve actually gets bent, the
Yeah,
46 you're speaking about.
yeah,
Speaking of the government,
yes.
just as an aside, new part of your overall rounding out your resume there, sir. You are now a member. Am I correct of the U.S. Treasury Department's Borrowing Advisory Committee? Is that correct?
That's correct. I was fortunate enough to join that last year. A true honor and a wonderful thing to be a part of.
And I'm not going to ask you to share your work on the committee because that is between you and the government. But how has it been balancing sort of this very large private sector mandate with government responsibilities as well?
Look, the way I would frame it is this, and I've done work over time with the Fed or other aspects of the official sector on different initiatives. I mentioned the LIBOR initiative I was part of. That was a very large public-private sector joint um, project and initiative. I would say that this is just another piece of the puzzle where our financial systems official sector, whether it be the CFTC, the Fed, um, the United States Treasury, and all the other agencies that I'm forgetting to mention now, are very good at assembling different public-private forums where they collect information from all different participants to give to kind of see things from all the different perspectives and angles. And so, I'm fortunate that I get to be one of the people that gets to participate in that. But I think it's more of a credit to all of those different official sector bodies that think with peripheral vision to regularly collect information from market participants and people that are involved. And I think that that's part of what makes our system unique. I think it's what helps make our system and our policymakers and our government employees better. And so I think it's a great thing that we do collectively across the financial system of pulling on this expertise that exists in all different forums. And this just happens to be my little piece, but there's tons of different committees and forums and things that the different bodies pull together to get expertise. And I think it's a tribute to the way that those places are run.
Great, good to hear. So I'll have some housekeeping about the podcast at the end, but before we go, when we have guests on the podcast, we always ask them if there is a particular cause, charitable or otherwise, that they'd like to amplify to use our name there. And other than the University of Michigan, which you, my wife, and other alums do a great job amplifying. Are there any others that are front of mind for you?
Sure. One thing that I kind of picked up, and I highly appreciate you asking this. One thing that I picked up on my travels in the UK was I got very involved in an organization called Fairy Bricks. It's a charitable firm that has a very simple mission to brighten the life of sick children through Lego, and all we really do is bring Lego into different communities, to hospitals, agnostic to the kind of the illnesses or whatever it is with the children, just to brighten those lives. And the power of play is very powerful in hospitals. We've done some great work out amongst the Ukrainian refugees. We have a long history
Yeah.
of touching hospitals across the all of Europe and obviously the UK. We did a very significant amount here. We got to a very significant amount here in the US over the past year, and we're always looking to expand. We've even gotten to some hospitals in the local Philadelphia area, which I know is very important and dear to the Liebman family's heart. So we're always looking for hospitals and places. So maybe this podcast will yield some listener somewhere who's got a hospital that wants to get in touch with us, and obviously more than happy to field that call.
That's awesome, and that's great that you do that. And on a let's say lighter note around Lego, you do have the most extensive personal collection I have ever seen, including your at-home design of the big house at Michigan, amongst other places. Um,
It can't be all bond markets and interest rates all the time. You got to find an outlet somewhere.
No, understood and agreed. Well, as we mentioned, with each episode of this podcast, one of the ideas behind doing this, and frankly, part of our broader move to independence, is we like to draw on resources and contacts, both personal and professional, from a wide variety of firms, not just Amplius and not just our team. So to that end, Jason Granet, thank you so much for coming on and joining us and sharing your expertise. And we will have future episodes coming up soon, both internal to Amplius and other guests. And for any of our listeners, if you'd like to give us feedback, let us know others that you would like to hear that are as informed as Jason. We'd be happy to try and get them on here. And Jason, thanks again.
Matt, thank you so much. It's great to be with you, and obviously go way along back with your family. You guys are first class through and through. So thank you for everything, and hopefully I get invited back when maybe the markets are going the other way and the cycle turns.
Sounds good. Thanks again.